So, with this chapter, we talk about retirement and estate planning. And one of the major issues in the US is obviously the Social Security retirement benefits. And on the consumer.gov page, there's a very nice explanation about your paycheck. And it basically goes through what's a paycheck, what's a direct deposit, what's a pay stub, the gross pay, and then what's FICA. FICA stands for the Federal Insurance Contributions Act. And what happens is every paycheck that you receive, your employer will set aside FICA taxes and Medicare taxes and income taxes and so on and so forth. So with the Social Security retirement benefits, we actually talk about what these are and how they actually benefit you. After all, the most important investment that everybody makes is towards their retirement, and it's also the highest in amount. So FICA taxes are the Social Security taxes that are withheld from wages from your employment income to support your retirement income payments. So you're basically paying into a pool of funds from which you're going to draw down retirement income. This is about 6.2% of your employment income, and this has a maximum. So it has a maximum taxable yearly earnings for retirement, disability, and survivor benefits. We talked about the blackout period in the previous chapters, but this is how you contribute through your paycheck to your Social Security contributions for your retirement. The Medicare tax is about 1.45% of your employment income, and this actually contributes into a pool for the Medicare, so that when you retire or when you are eligible to use Medicare, you could draw down or you could get payments from the Medicare pool. How do you qualify for it? Social Security works on credits, and you earn one credit for every $1,260 as of 2017, and this number changes every year, in employment income. And you can earn a maximum of 4 credits per year. And if you work 10 years, you accumulate 40 credits and you are fully insured for retirement. At that point, even if you were to stop working, you will be fully insured. However, the amounts will be small. So you have to continue working to receive significant Social Security benefits. And the more you work, the more you contribute, and higher payments you're going to receive. Retirement benefit is based on your earnings history, and that's actually indexed for inflation. So the benefits that you're going to receive are adjusted for inflation, and it actually is based on your earning history, how much you accumulate and how much earnings you have had in the past. Basic retirement benefit is calculated based on your top 35 years of earnings. And full benefit retirement age is 67 for those born after 1960. And you will have your full benefits, entire benefits, at your full benefit age. That's the 67. You can get reduced benefits earlier, but no earlier than 62. And if you retire later, then you can actually get a little bit more benefits, retirement benefits. Social Security Administration has an online presence, a webpage. And if you go through your retirement, your disability, you could sign in. You could actually, take a look at, where you stand, how much contributions you made, how many credits you collected, and how much money you would get if you were to continue. And it's really nice in that Social Security will give you an estimated income, retirement income, as of today, or in today's money, in today's dollars, of how much you would receive when you retire. But that has an assumption of you continue working at your current level, current income level. But it may be a good idea to create an online account so you would see where you stand, how many credits you have, And also you need to check your earnings history every year. There have been cases where the employers skip payments, and legally they have to pay, but you know that's why we have a court system and a judicial system and a prison system. Not everybody does. So it is your retirement, so you need to make sure that everything is paid properly and that everything is going according to plan. It's also a good idea to have that online account because you can see where you stand and how much money you are going to receive, and that actually gives you an idea of if you're happy with it. If not, then we'll talk about how much to save. You need to have a retirement goal. What do you want to do? How much money you want to have? And how much money do you want to receive? And based on that retirement goal, you need to start saving while you're working. So how long do you want to work? And how long are you expected to live in retirement? So at the beginning of the class, I've been talking about, how optimization of life. And obviously that's different for everybody, but optimization refers to, spending now a little, saving for some, for the future. However, we are not certain that we're going to retire or we're going to live to retire. And however, on the other hand, if you do and you live to make 100 or 110, well, you want to have money for it. So we want to save for our retirement and a long life after retirement. However, we want to also take the opportunity to spend a little right now, to just live the life. However, without saving, you won't have a good retirement, and there is no such thing as free money. And if you don't have enough to retire, then you won't have an income in retirement, and you cannot retire, which means that you're going to have to work even when you're old. And as you get older, it's going to be harder to work, just physically and mentally. And when you're younger, 20s and 30s, and it will be significantly easier to find work and to have work and to work. So what happens if you don't have enough for retirement? Well, you will have to delay retirement, or you cannot retire. You may want to continue working, even if it means at a reduced work. You may want to move to a lower cost of living, and this is very popular. A lot of people consider moving to countries that's actually cheaper to live, in Latin America, for instance, or in other states where it's actually more retired people friendly, and therefore this may be your way of dealing with a lower income at your retirement. You can downsize. Obviously, when you are retired, you may not need a house that big. You may not need, an SUV that big, and so on and so forth. So you may want to downsize. However, you need to consider that as you retire, you're going to have more expenses with respect to healthcare, with respect to your day-to-day care. How do you save for retirement? Well, obviously, first thing is your paycheck. You may want to actually set aside from your paycheck first, meaning, as soon as you receive a paycheck, you say, okay, let's put some money onto my retirement, and then whatever is left, then you actually pay for your other expenses. So save first. You could have automatic payroll deductions into retirement. You could consider putting your bonuses, gifts, and tax refunds, etc., into your retirement fund. You could get a second job just for the retirement. I mean, depending on what type of job that you do, but perhaps getting a job that you like as a second job, just for, just put a few $1,000s into your retirement, especially when you're young, may go a long way. There are employment-sponsored retirement plans. We talked about it in previous chapters. So these can be tax-sheltered. Employer-sponsored retirement plans actually qualify for this tax sheltering. Defined contribution retirement plans, and obviously there are limits as to how much you can contribute. Tax-sheltered retirement plans are, the government is actually doing us a favor, the taxpayers, and giving us a tax shelter for our contributions into these retirement plans. These retirement plans will have will not be subject to income taxes if you make any contributions, and your contributions may be tax deductible, which makes it very nice, and your earnings on these plans are tax deferred. So even what you would have paid in taxes actually works to make money for the future, and therefore this tax deferred or tax deferring your earnings actually makes you money in the long run significantly. The Employee Retirement Income Security Act is the act that regulates the employer-sponsored retirement plans, and it actually makes them qualified for tax sheltering. Defined contribution retirement plan is what we talked in the previous chapters. They can be non-contributory or contributory, and employers often match or match a certain percentage of employees' contribution. It can be automatic, and there can be automatic escalation, and it may not be. So if it's an automatic enrollment, then as soon as you get the job, you're enrolled into this, and the employer will match. If not, then you have to ask for it. There can be an automatic escalation, meaning that the more you stay with the company, the company may be matching more of your retirement savings. And this is a way to earn employee loyalty. They want you to work for them for a longer period of time. And therefore, for the first couple of years, they may match, say, up to 5% of your income. And then, they could go up to 7, 8, and 10, and whatever the percentage is of your overall income. And the more you stay, the automatic escalation would make you qualified for the employer's matching your contribution into your retirement. Most of these contribution retirement plans will have employer-approved investments. So you cannot just say, I'm going to put that money in Apple. You have to, consider what list is available to you and choose one of those approved investment lists and invest in one of those. There are limits on contributions by the tax authority. So if it is a 401 or a 403 or 457, the limit is $18,000 per year. If it's a simple IRA, which we're going to talk in a minute, it's $12,500 per year per person. So the personal retirement accounts or individual retirement accounts, IRA, these are the most traditional. And so perhaps we should go with the traditional IRAs. And then there comes the Roth IRAs. The main difference is what happens to your withdrawals. So traditional IRAs are funded with pre-tax, and therefore you don't pay taxes on your contributions, meaning it is the pre-tax money that you set aside. So it makes it tax deductible in a way. However, if you were to withdraw, then your withdrawals are taxed. However, the Roth IRA are funded with post-tax dollars, and therefore, because they're post-tax, they're your money after paying taxes, net of taxes, and therefore the withdrawals that you do are tax-free. Deposit limit is $5,500, and if you are 50 plus, then there's a catch-up clause, and you could actually pay up to $6,500. There are not so common, but some other personal retirement accounts, KEO accounts, SEP IRAs, and solo 401s, and these are more for the people who are self-employed or small business owners, and they're very specific to this group of people. So when you do change a job, and we're talking about employer-sponsored plans, you can leave the funds in the old employer's program. So for instance, I work for Loyola, and Loyola has a retirement plan, and they do match some of our investments or retirement savings. And if I were to leave Loyola, I could leave the money in Loyola's employer program. That doesn't mean that they're going to continue contributing it. It just means that my money will be in an account that is actually managed by Loyola. So think of it like this. Loyola has its own retirement funds managed by TIAA-CREF. And every company will have a managing, brokerage company or investment company that will have, or they will hold these accounts. Now, these accounts, remember, self-directed investment within the employer and approved investments. So these accounts will have restrictions as to what can be invested through those accounts. So if I were to leave Loyola, I could actually leave the money in my own account, but the account will be according to Loyola's rules and regulations towards investments. And therefore, I could leave it within old employer's program. I could transfer the funds to a new employer's plan, and usually there's no penalty for this because you're going from one retirement to another retirement plan. You could roll over the funds into a rollover IRA. However, if the IRA type is different, like a Roth, then there may be some sort of penalty that may associate with that rollover or transfer. Or I could take the funds. If I were to take the money out of that account, then I would pay income taxes, and I also would pay a 10% penalty. And this usually is a bad idea. And your book actually says very bad idea. You lose a lot of money because you pay income taxes on this that you wouldn't otherwise pay right now. And there's a 10% penalty. It's a penalty. So let's say that you accumulate, all your life, say $500,000, and then all of a sudden you want to get your money out, then you pay 10%, $50,000 just on the penalty, plus you pay income taxes on those contributions. So now that we talked about the Social Security, let's talk about estate planning. The terminology probate is the first terminology that we need to talk. A probate court is a special court, which is its job is to distribute assets of people who have died. It is a very supervised process that will allow the creditors to present claims against an estate. So, for instance, somebody passes away, there's the estate, and it goes to a probate court, and the probate court will basically receive all creditors who have a claim on the estate, and all heirs get together in the probate court, and the probate court will be the special court who decides on the distribution of assets according to the rules and regulations. And it ensures the transfer of deceased assets to the rightful beneficiaries. So it is just a process in which everybody gets their fair share, including the creditors, including the heirs. Non-probate property refers to the property that does not go through the probate. So it doesn't have to go through the probate court. Most of your estate can be set up as a non-probate property. And these non-probate property does not have to go through the probate court, and therefore they bypass the probate process. So most assets are transferred by contract. So think of it like this. Assets can be transferred by beneficiary designation, property ownership designation, or payable on death contract designation. So these are most of the time non-probate properties, and their transfers are basically by beneficiary, property ownership, or payable on death. And since these designations are made before the person passes away, then the probate property does not actually apply here. The rest of your estate, which are actually the probate property, will go through the probate court. But if you have a will, that makes a lot of things significantly easier. You can actually have, through your will, designate who the desired heirs are and what they're going to receive, and you can actually designate an executor. An executor is the person who's named in the will to carry out your provisions. It's the person who gets to do what you want him or her to do after you die with respect to your estate and your heirs, and how to split that estate among your heirs. An executor manages the assets until the estate is passed on to heirs. So if there is a period in which the heirs take possession of the estate, and after you pass away, that period of time, the executor will actually manage the assets, and obviously the executor gets paid. If a will is valid, then it's not likely to be challenged, and it's important to have a will and also a living will. But there's some terminology, like for instance, a codicil is a legal instrument to make minor changes to a will without actually changing the entire will or having the expense or going through the process of writing a new will. You can actually add a codicil that makes minor changes to a will. It is a good idea to appoint a guardian if you have a minor children, just to make sure that you can actually designate who that guardian will be. But if there is no will, then the state law determines the distribution of your property. It is a good idea to have a will. It doesn't cost as much, and you know, state law may not be what you wish your heirs to receive. Now, there are very specific rules about spouses. Spouses have legal rights to each other's estates. There are a little bit of variations across states. However, property acquired during the marriage becomes the property of both spouses. So, I mean, these are legal issues, obviously, but you know, if there's a will that supersedes the, not so sure, but it supersedes the spousal property privileges. But again, it's a legal issue, so I think that it's best to discuss with a estate lawyer. Now, trusts. Many people actually transfer assets through trusts. It makes it convenient, it makes it fast, it makes it really easy, although it may have a little bit of cost, but it is a way to transfer assets. Living trusts are established while the grantor is alive, and trusts can be revocable or irrevocable. If they are revocable, then you can make changes. If they are irrevocable, then it is set in stone. You can't make changes to the trust. The living trust is established while the grantor is alive. How about, on the other hand, testamentary trusts take effect only upon the death of the grantor. So this is a trust that would actually kick in after the person dies with respect to the setting up the trust. Now, with respect to letter of last instructions, now letter of last instructions is not a will, so it's not as binding as a will. It usually includes things such as funeral and burial wishes, location of documents, important documents, contact information for friends and relatives. I mean, think of it like you're going to have an executor who's going to execute your will, but then how does he contact the friends and family who is supposed to receive certain assets? So you need to leave him or her contact information to call those people to tell them that they are going to receive part of your estate. If there are low value sentimental items, then you can include these into your lost instructions. You know, who receives them, who receives your pictures, who receives your certain personal items, and so on and so forth. It's not a binding instruction, so it's not like a will. Will is binding, especially if it's a valid will, then it's really hard to contest it. But letter of lost instructions it's simply a letter. You could write it yourself, and people have the freedom to respect it or not. There are taxes involved with inheritance. The federal estate taxes are assessed against the deceased person's estate before property is transferred to heirs. So federal estate tax is assessed against the deceased person's entire estate before the property can be transferred to their heirs. There's a marital deduction, which allows an estate to pass on an unlimited amount of assets to a surviving spouse free of estate taxes. So that's called the marital deduction. Keep in mind, this is for federal estate taxes. So states may have different requirements. There's basic exclusion amount, value of assets that may be transferred to heirs without incurring an estate tax is $5.45 million. So most people won't have to worry about this federal estate tax. However, if you're going to receive anything more than $5.45 million, then the federal estate tax will be a concern. There's something called a gift tax exclusion, which is $14,000 per person per year. This is an exclusion from the federal estate taxes. Inheritance tax is paid by heirs, and only 8 states have this tax. So it's not as common. The remainder of the states do not have inheritance tax. So this concludes our discussion about the retirement and estate planning. And as usual, if you have any questions, please do let me know. Although this chapter is a little bit more on the legal side, so some of the legal questions I may not be able to answer in specific or in detail, and your book again may not be the best legal source or best updated legal source with respect to the estate planning's legal aspects of it. So it's always a good idea to consult with an estate planning lawyer, licensed and registered to the bar, and specific to the state that you're living in, to have his or her opinion with respect to your specific estate planning questions. But anything that you have a question about the topics as they relate to our course, please do let me know. Thank you.